Our special guest today is Lyn Alden of Lyn Alden Strategy. You're watching episode 6 of Raise Your Average.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Welcome, everyone. I'm Pierre Daly, Managing Editor of AdvisorAnalyst.com. My co-hosts are Mike Philbrick and Rodrigo Gordillo of Resolve Asset Management Global. And our very special guest is Lyn Alden of Lyn Alden Strategy. For those of you who don't know it, Lyn is one of the most profound macroeconomic thinkers in the market today. And used to be, you read 4 or 5 macro pieces you would read from various sources, and then you'd sort of put your own ideas together or find a way to connect them. And what I found really sort of exciting about reading and listening to Lyn's macroeconomic framework was that she just, Lyn's already doing that. Like you're already, you're already taking all the moving parts and connecting them. So Lyn, welcome to the show. I'm really excited. I think we're all really excited to have this conversation. Please welcome Lyn Alden of Lyn Alden Strategy. Hi, Lyn. How are you?
I'm good. Thanks so much for having me here. And, I totally agree. I mean, basically, we're in an environment now where we have so much information. And so the value is trying to find ways to synthesize that information and filter out some of it, interpret it. That's what I try to do. And also sources that I rely on, I look for people that can kind of take what's important out of the massive amount of information that we all are just in covered with.
Yeah. Well, I love the.
If you look at,
go ahead, Mike.
Go ahead.
It's okay.
I love the way Lyn's investment strategy website is laid out as well. So you've got the beginner, the intermediate, and sort of the more experienced global macro themes. So if anyone hasn't had a chance to look at Lyn Alden investment strategy, there's a lot more there than what we may discuss today. I think we're going to try and keep it at the higher level, at the more experienced level, get a glimpse into Lyn's sort of global macro framework and some of the implications that fiscal policy and monetary policy are having on asset prices today, and what the potential outcomes can be, and how you might think about preparing your portfolio for that. So we're going to stay on the experience side, but I would also say there's lots of fodder in her investment musings beyond that. So for those who haven't had a chance to check it out, they should go and do that for sure.
That's great. So Lyn, I think it might make sense to start from your beginnings, talk about how you got started, how you came into the investing world, into the world of finance, and then we could get into your macroeconomic framework. Absolutely,
yeah. My background's kind of a weird path to get here, but it's not super weird because a lot of engineers do go into finance. But so for people that aren't familiar with me, my background is a blend of engineering and finance. And going back further than that, I was always interested in investing. So before I went to any sort of university, it was just kind of a passion of mine. It just kind of came out of nowhere in a sense. But when it came time to go to university, I focused on engineering because my other interest was technology and the application of technology. And so I pursued that for several years. But I was always investing on the side, including, I had an earlier blog where I would write about different types of stocks out there. I eventually sold that to a larger publishing company. And it was in late 2016 that I decided to launch Lyn Alden Investment Strategy, which is a more rigorous kind of approach, more professional approach to basically provide research to people, both for retail investors and for institutional or, professional money managers. And so my overall approach is mainly to focus on kind of quantified methods of what's going on. I like, numbers more so than narratives, although I try to, make sure I understand what's happening qualitatively as well. But a lot of what I try to do is identify bottlenecks, identify big turning points, things like that, and pay attention to multiple asset classes to find things that you can rebalance into, that you can basically lean into things that are out of favor and kind of rotate out of things that become very, expensive or consensus. And my primary kind of asset class of choice is equities, because with equities, of course, you can dabble in multiple different types of assets indirectly, because You can, for example, invest in commodity producers, or you can invest in stocks that benefit from higher rates or stocks that benefit from lower rates, and kind of all these different levers that we can pull. But I also go into other asset classes as well. And so overall, that's how I approach things. A lot of people read the work and they a lot of engineers resonate with it because it's kind of like it lays out what's happening kind of step by step and takes a hard problem and kind of, my philosophy is to break it down into small problems, solve them independently, put them back together. And so that's really how I approach global macro. And overall, what I say I do is that basically it's equity investing with a global macro overlay. And so I do go into individual companies but I also, always take a step back and remain macro aware of what I'm doing.
And how have you found that? I mean, obviously, it's been a very active macro world that we have been existing in since 2017. And, I think the way that you explain some of the structural relationships in such an approachable way is very informative and helps the investors sort of get their head wrapped around what the linkages are between, monetary policy steps that are taken, how they affect money supply, and now this new implication with respect to maybe fiscal policy taking a larger role. Maybe you want to jump into your overarching global macro framework at the moment and the levers that are at play and how they might be impacting steps that the Fed may have to take, they may not want to take, or corners that they're going to be forced into. Why don't you share that with us?
Yeah, absolutely. And you're totally right. This is a very macro-heavy environment. And in many ways, that's why I had to adopt an increasingly, macro overlay to the type of work I was doing. It's not really the environment where you can just kind of put your head down and focus on individual stocks. You have to really kind of be aware of some of the big forces that can push them around, right? So last year alone, we had, the biggest economic shock in modern history, followed by the biggest monetary fiscal response in modern history. You have to go back all the way to the World War II to find a larger response. And so, my overall framework kind of combines a couple different elements, but I would say the largest influence has been Ray Dalio's long-term debt cycle concept. And the way, what that is basically that if you look at the normal business cycle, there's the short-term debt cycle, which is the normal 5 to 10 year business cycle that we're all familiar with. You have the previous recession, then you have the recovery. Then we start to build up debt in the system again. You start to get more and more kind of euphoria among market participants. Usually the Fed comes in, or the other central banks come in and they start raising interest rates to kind of put a brake on that. And eventually some sort of catalyst happens. We start to get slowing GDP, and then sometimes you kind of narrowly avoid a recession. Other times you have enough of a catalyst to actually get a recession, and that the Federal Reserve has to cut interest rates. And usually there's some sort of fiscal response. And if you kind of put most of a bunch of those together over time, you'd expect it to maybe look like a sine wave of rising and falling debt, rising and falling interest rates. But it really doesn't quite work out like that because each time basically there's lower and lower interest rates and higher leverage in the system as a percentage of GDP because each kind of end of cycle. They policymakers kind of intervene before it fully deleverages. It basically kind of deleverage like half the way, and then kind of start building up leverage from there. And so when you string several of those together for maybe 5 decades or more, eventually you run into a very different environment because eventually interest rates at zero, debt level becomes extremely high, and some of those same tools that worked in previous cycles no longer work anymore because you can only get so negative in terms of interest rates before it doesn't work. And so that's where you start to see, even more unconventional policies. So first, you see, asset price purchases. Asset purchases by the central bank, where they can do quantitative easing. In previous eras, they would call it different things, but it's a very similar process where you, basically solidify the banking system. And then the later step after that is large fiscal injections. So that could be bailouts of corporations. That could be, direct checks to people. That could be expanded unemployment benefits. That could be massive infrastructure spending, whatever the case may be. That could be, even it doesn't have to be spending either. It could be tax cuts that are not balanced by any sort of, spending reduction. And so that tends to be a very different environment. And so one of the risks that people can run into is that if they're assuming that, recessions kind of follow the same sort of path, they could be caught off guard by the ending of a long-term debt cycle, which sometimes has very unintuitive outcomes. in many ways, like we saw last year, which is basically we saw this huge disconnect between asset prices and economic performance, in part because we had the largest, fiscal stimulus ever, in modern history, kind of, propping a lot of that up. And so overall, my approach is basically to look at the rate of change of the normal business cycle, but then also keep in mind that really long-term debt cycle of how, basically to expect the unexpected from policymakers when you start running into the zero bound and when asset purchases start to become a big part of their toolkit.
And so how are you seeing that play out today as you're looking at the landscape? I think you're sort of on record as being more in the inflationary camp now, less in the deflationary camp. And we've still got those fairly strong forces of deflation from debt and demographics and some productivity gains in technology. And on the other side of that, we've got, the different inflationary forces that are coming into play. So how are you seeing that struggle sort of play out?
Yeah, I think you put it really well. That basically there's two really powerful forces there. I mean, on one hand, you have deflation, you have aging demographics, you have technology, you have offshoring, all these different levers that make things cheap and that basically can slow down growth and basically suppress wages and keep inflation at bay. On the other hand, we have, if you look at the types of inflation, there's a big difference between what, say, commodities have been doing, before last year compared to, say, healthcare costs. Healthcare costs in many countries, especially the United States, we actually have the highest healthcare costs in the world down here. But basically, there's just so many forces on either side. And that was, the case back, in the previous long-term debt cycle as well. So the previous time we had the ending of a long-term debt cycle was the 1930s, and then, it was bleeding into the 1940s. And they had a very similar environment there. So the 1930s were extremely disinflationary, and it was only because of this, massive policy response as well as, external factors that you got that more inflationary kind of rebound out of it. And so we're kind of seeing a similar thing now, where the 2010s in many ways were very disinflationary. We had a period of commodity oversupply, so most commodities were cheap. That helped keep a lot of kind of basic pricing down. We had a lot of outsourcing, so things like electronics and apparel kept getting cheaper and cheaper. And the real kind of worries were the services sector. So anything where you're paying someone to do something, essentially, whether it's education or healthcare, or even things that are unrelated because you're paying for their, if you're hiring someone to do something for you, you're basically paying for their high healthcare and their high educational costs as well. And so those areas were the part where we actually saw some actual price increases. But going forward, especially as we saw over the past year, the major tools that the policymakers have to combat inflation to combat deflation and create inflation can become increasingly aggressive as some of those other tools, basically fail to work. And so a lot of people thought, a decade ago that quantitative easing would be inflationary. That was kind of the narrative back then. But what we saw last time, as well as the previous time in history when that was done, is that basically increasing, the base money is not very inflationary because, you're not necessarily increasing the broad money supply. You're not getting money into the hands of people. You're not having more money chase fewer goods. And so there's no real reason for it to be inflationary. At best, you can call it anti-deflationary in the sense that it prevents a bank collapse or things like that. But it doesn't really just result in what we generally think of as broad inflation. However, if you directly increase the broad money supply by quite a bit, through massive fiscal spending that is in large part monetized by the central bank, which is very different than what happened a decade ago, then you're more at risk of inflation. It's still not guaranteed because you still have to, you have to compare the magnitude of that increase in the broad money supply compared to the various factors that are disinflationary and that press down on monetary velocity. But overall, at least now you're in the game. Now kind of inflation really is an option on the table, and it becomes this tug of war between two forces. And so when I'm kind of looking out for potential inflation, what I'm most paying attention to is the fiscal spending that's happening, and then how is that fiscal spending being financed? Is there real investors buying the bonds, or are a lot of the bonds being bought by the banking system and the central bank? And then, indirectly, then you can then watch the broad money supply go up, and then see, is most of that pooling in the upper classes, or is it getting widely distributed? Because again, part of the reason why some of the increases over the past decade have not been very inflationary is because we've actually had, a pretty substantial wealth concentration. And so a lot of that money kind of wound up in the top 10% or so, and therefore winds up in financial assets rather than in consumer goods. And, I guess the last point I would talk about is that a lot of economists, when people are talking about inflation, most people having that debate are looking at it from an economic perspective. And I rarely see them talk about the commodity cycle. So if you look back in history, we have this, roughly 15-year commodity cycle. It varies, but basically, you have a period of strong demand. Commodity prices are high. That encourages a lot of producers to come and create new supply. Build new mines, find new reserves, whatever the case may be for that particular commodity. And then some sort of slowdown happens, or just the sheer amount of new supply coming into the market kills the prices. And then you're left with a period of oversupply. But because a lot of those mines, like a copper mine, takes a very, very long time from finding the reserve to basically making an outputting mine. The same thing for a very big oil discovery, or whatever the commodity and case may be. There's that giant lag time. And so when you have that period where you're oversupplied and prices are low and it doesn't justify new sources coming online, that kind of sets the stage many years later for that inevitable bull market in commodities because you haven't invested enough. And so it's important that this disinflationary period that we've had over the past 10 years has taken place during a time of commodity oversupply. This started ever since about 2008, and whereas now it looks like in some ways that might be coming to an end, especially when you look at the copper, where that is, because there's not a ton of new supply there. We have a pretty big forecast for higher demand in the decades ahead, and then even with energy, which has been the most structurally oversupplied area, we've actually had pretty weak capex for several years now. And then of course 2020 killed a lot of the capex, and then we combine that with the fact that with ESG mandates, some of the financing that, for example, has financed unprofitable North American shale oil for the past decade is not really there in the same way that it was maybe 5-10 years ago. And so we have a couple kind of variables coming together that potentially makes the 2020s a little bit more inflationary than I think consensus would expect. But it's still that hinges on that basically the policymakers are likely to continue doing larger fiscal stimulus than people expect. And so that view can always change if you were to get a sharp change in fiscal monetary policy.
So you're getting kind of the double whammy of the supply push inflation and the demand pull inflation, right? As maybe demand stays the same, but you're having a lack of supply from commodity producers, and you have this massive fiscal stimulus that, if done right, it goes to everybody's pockets. And these are consumers that are going to spend most of the money that they get versus the upper echelon, mostly just hodling it, putting it into their investment accounts and real estate prices, right? So it seems to be like an interesting pivot point from an inflationary perspective. It could always change, of course, depending on how things turn out. But it is something that I think investors. I just saw a poll recently of the amount of consumers that are worried about inflation, and it was like 75%. I don't remember the last time that I saw something like that. Of course, that's the macro side of me makes me feel like I should take the opposite side of that trade.
Yeah, I think it's one of those. It's
you're still watching though, right? You're not taking any hard positions. What are you seeing, and when does this play out?
Yeah, I mean, I often tilt my portfolio rather than go all in on an idea, and so I have been tilted towards this reflationary idea, and then the question is how long to press that, how long to keep pushing that. And for example, I've already dialed back some of the things, like for example, copper stocks went straight up, and so kind of dial back things that might be a little bit overdone. But overall, I still have a reflationary tilt to my portfolio. And some of the things I'm watching, I mean, there's kind of the near term and then the longer term. So the near term is we're going to have attractive base effects in the next few months. And so, when inflation is discussed, what you're generally talking about is the year-over-year consumer price index, or a couple other ways to measure it. So if you look back last year, the lowest points, for the CPI were that April and May period, at least for the United States. But that, I'd assume that would apply for most of the rest of the world. And so when you're comparing year over year, back when we had the data point from February, but the February of 2020 was still pretty high back then, and so that year over year comparison was still somewhat tough. But when you look out to the April and May periods, that year over year comparison is very favorable, and so you're likely to get a somewhat high headline print. It could be comfortably 3% or more, just based on basic CPI kind of maintaining its mild upward trend now, and then you could get notably higher than that if that doesn't become as transient as people think. So basically, the deflationary case would be okay. You're going to get the base effects, and then it's going to wear off, and you're going to go back to normal, and it's going to basically all of that inflationary force is going to get eaten by the larger deflationary force. The other way of looking at it is that they're already talking about more stimulus. They're talking about the potential for a $3 trillion infrastructure bill, and that can keep that going potentially for longer than people expect. And as far as people saving it, it's kind of a spectrum, right? So we actually have seen increased saving. And that's why, even though we increased broad money supply by something like 27% year over year, we of course haven't seen, 27% average price increases. Maybe in commodities we have, ironically. I mean, many commodities are up that far, but broad products are not necessarily up that much, in large part because, if you look at, say, personal income in the United States, you spiked above trend, right? So even though we're in a giant recession, people on average had more income than they otherwise would have had. But at the same time, they're barred from spending it, right? So they can't travel as easily or as comfortably. They're not doing business travel as much. A lot of expenses that they otherwise might have had are on hold. And as a natural result, a lot of them have saved it. They've deleveraged a little bit. Or they've shifted their spending towards things that are inherently cheaper and more deflationary, like technology, basically, more streaming packages but less gasoline consumption, for example. But as that starts to end and consumers have quite a bit of excess funds, that can move back into the real economy. And so it'll be inflation is one of those things that does have a qualitative component to it, because once people expect that their money is going to not be as valuable 6 months, 12 months from now, they're more likely to spend it. Whereas if they have the perception that prices are going to stay flat or even go down, they're more likely to wait for certain purchases. So there is that qualitative component, but I'm mostly watching some of these quantitative underpinnings. So first we get through the base effects, and then we see what's happening with ongoing fiscal stimulus, as well as watching what's happening with energy prices. Is OPEC basically increasing supply? Or are they, staying, pretty disciplined in that time? When you have those couple of variables right, then you can have a pretty good handle on what's happening with inflation.
Can I just ask a question about the base effect? I've always been interested in how this actually has any impact whatsoever. It really is starting point, ending point. So the listeners that may have not heard of this before, what is the base effect, and why do you think it matters so much when it's just simply year over year?
It's a
single data point can have such a large effect.
Yeah, so it's one of those things that it shouldn't matter as much as it does. We should basically look through it, and there are easy ways to look through it. You can look at month over month numbers. You can look at 2-year numbers, right? So you can factor out that 1 year difference. And so those are some of the important things to do when you're aware of the base effects. But essentially, what a base effect is if you look at CPI over time, in not year-over-year terms, you just look at the consumer price index, you'll see it mostly going up as like a straight line, and it wobbles a little bit, but it's mostly going up. But if you have a big enough economic shock, you get a little dip, and then you kind of rebound to it. And if you're going up and you're 12 months later and you're comparing yourself to where you were 12 months ago, you're comparing yourself to that bottom of that dip. And so if you map the chart in year-over-year terms, that year-over-year number that you're getting, it's going to be reported. The April numbers reported in May, the May numbers reported in June. That can look like a pretty big spike in inflation. And so it's one of those things where headline numbers, they impact people more than you'd think. There's algorithms out there, but a well-done algorithm should recognize that sort of thing. But it's all like, I was watching, for example, when the February numbers came out. And people were saying, inflation was 1.7%, so it's still low. And it's like, well, yeah, because that's up against pretty decent, base effects, and people still haven't really gotten able to spend a lot of things that they had. And so as you look out, I think the same people that are shocked that inflation was only 1.7% are going to be like, wait, what do you mean it's 3%? And so it's like, well, okay, look forward a little bit and see if it's actually still going to be 3% after we get past the base effects. It might be, if you do get enough of an ongoing stimulus, maybe it could be. But if they were to, throttle that back, then you're comparing yourself to, say, summer of late summer of 2020, which by then you're out of that dip, and so you have more fair 12-month comparisons. And so first, it's mainly just like a headline shocker that people that aren't familiar with base effects could be surprised by. But then as you look forward, that's when you get into the deeper question of whether or not we're going to have sustained inflation or not.
I think it actually might be informative. Sort of two things on base effect. One is the experience the individual has. They have a memory that's sort of a year long. So what did I pay for X last year? What am I paying for X this year? And so they're experiencing sort of that 1 year window in their memory. And I think the other thing is it's been so long since we've experienced this type of environment that I think the collective memory of the investing public really has no recollection of how this type of economic regime and environment actually functions and what its implications are for asset prices. So I wonder, Lyn, if you might walk us through sort of that 1930-40 example to sort of refresh memories across the board of how, when you get into this ending period of the long-term debt cycle, how things start to function. I've heard you talk about this a few times, and I think the listeners would probably really enjoy that history lesson of the 30s and 40s and the attempt at yield curve control and what the implications are for today and whatnot. I think that would be very insightful.
Yeah, sure. And so one way I'd start by saying is that if you go back to the concept of the long-term debt cycle, the next step of understanding that is to realize that there's really two totally different types of debt. There's private debt and then there's public debt, and they can have very different implications for inflation and things like that. And so if you look back in the 1930s and 40s, first you had a private debt bubble. And so going into 1929, federal debt as a percentage of GDP in the United States, I use the United States for a lot of my numbers, but if you look at global numbers, most developed markets were generally on the same sequence, and just magnitudes were different based on different conditions at the time. But overall, you don't generally see markets on totally opposite sides of this, and so these things kind of tend to come in clusters. But so the 1930s, going into the 1930s, the United States has very high private debt. A lot of it was speculative, a lot of it was farmer debt, whereas federal debt was quite low. And then you got that 1929 crash. And then when you went into the 1930s, you started to get bank failures. You got declining GDP. And so in that 1932, 1933 period is when we really kind of hit the bottom. And so debt, private debt to GDP was extremely high. And they did start out with fiscal, policies. But in the beginning, they were kind of moderately sized. They weren't enormous, but they were substantial. So the first steps there were to do something kind of like quantitative easing, in the sense that banks had gold reserves and then they had dollar-based liabilities. And so one of the things they did was devalue the dollar relative to gold, and that was essentially like quantitative easing, where you basically increase the amount of bank reserves in the system compared to their liabilities, and that helped stop that massive destruction that was happening with banks going under. And back then there was no FDIC insurance, so if a bank failed, your deposits were just destroyed. And so unlike these past few decades, that during that there was like a several-year window where broad money supply actually went down. So there's just fewer dollars in existence in the broad sense. But once they devalued the dollar relative to gold, shored up the banking system, you basically quickly ended that. You came out of that, and you got that strong reflationary response. And it still wasn't very high in inflation. When you look at the decade as a whole, you had outright deflation. Then you overshot a little bit, but overall, the 1930s were not a very inflationary decade. It was a pretty flat decade when you kind of tune out the big moves in the middle there. And then as you got deeper into the 1930s, you had substantial fiscal spending, but it still wasn't on a massive scale. We had, we saw public works projects and things like that, but a lot of it, as a percentage of GDP, was still relatively tame. And you got a second recession in the late 1930s, and overall, it was just a period of ongoing stagnation. Essentially, you still weren't at new stock highs. You weren't having any sort of roaring economy. And
1937 was a terrible equity market, right? Big down year in 37.
Yes.
And I think that's when a stimulus package came in. Is that when the New Deal came in?
Well, that came in a couple different parts, and so there were kind of different components of that. But yeah, that was another renewed effort to basically increase fiscal spending. But also because a lot of the world economy was going through this, of course, you had tensions in Europe, you had all sorts of issues, and for a variety of reasons that helped contribute to the war that happened in the 1940s. And so when you had the 1940s, you had multiple stagnant economies kind of go into this, and that was a catalyst to do absolutely massive fiscal spending. And so if you look at the deficits as a percentage of GDP in the 1940s, they blew away anything that we saw in the 1930s. And so, you had deficits of 20 to 30% or more of GDP because it was existential. You're fighting this all-out war. And so, but in that environment, I mean, a lot of the spending, even though a lot of the combat's happening overseas, a lot of that is you're building things domestically. You're if you look at industrial production in the United States, that went up. It went like almost tripled during like a period from the very late 30s to like the late 40s. And even after the war, when it kind of corrected a little bit, it still retained most of that. They were able to kind of pivot to putting those war machines to domestic use. And so when you had that kind of massive fiscal injection to build up the economy, and when soldiers came home, they got GI Bills, so they got like free training, and some of them went to college, other ones went to basically learn a trade, and so basically you saw a massive fiscal injection. And during that decade, inflation was, substantial. It was comparable to the 1970s. But instead of being this kind of steady inflation that kept rising, you had these massive spikes of inflation followed by like no inflation, like another massive spike. And so if you look at 1942, 1947, and then again, I believe in 1951, you had these really big inflationary spikes that were double digits. But because at that point, the private debt bubble was mostly worked through. So the private debt had deleveraged a lot, whereas now you're ramping up the public debt, the federal debt. And they couldn't afford to have very high interest rates at that time when federal debt was going over 100% of GDP. And so that was where they did yield curve control. So the Federal Reserve said, we're gonna buy any treasury bonds that go over 2.5% yield. And so that basically set a ceiling for what yields could do. And they actually had multiple ceilings. So if you look at the short end of the yield curve, they had a limit there. Then the middle of the yield curve, they had another limit. And then the long end of the yield curve, they had 2.5%. And so what you basically had was a moderately steep but artificial low yield curve. And then inflation was doing whatever it's going to do. And so if you look at if you chart inflation and 10-year yields during that decade, inflation's like a wild ride with these double-digit dips and then back down to normal, whereas the 10-year yield was just this flat line at 2.5%. It's completely artificial. They totally overrode the market. And if you look at the Federal Reserve balance sheet from the early 1940s to the mid 1940s, they increased their holdings of treasuries tenfold. And overall, you had a very strong nominal GDP growth, in part because you had pretty massive inflation. But then also a lot of that was productive. And then after the war, they were able to pivot. Basically, they never really paid off the debt. It's not like U.S. debt, fell dramatically, but they basically held it steady for a while as the economy kept growing. And so through a combination of inflation and real growth, they were able to get out of that debt trap. But it was a painful time for anyone holding cash or bonds because say you were holding a 10-year treasury in the beginning of the 1940s, by the end of the decade, even though you got all your purchasing power back, you made something like 25% because you got 2.5% a year, but your purchasing power in real terms went down by over 30%, and that'd be even worse if you were holding cash. And so overall, that's I often compare that environment to the 2010s and the 2020s, because going in, if you look at the charts of the you separate private debt from public debt. If you look at interest rates and say the monetary base as a percentage of GDP, a lot of what happened during that 1930s, 1940s period looks a lot like what happened starting with the Great Financial Crisis. So we had this private debt bubble build up. We saw a massive collapse. Then we saw a ramp up in the monetary base to basically recapitalize the banking system. But that wasn't outright inflationary, because just like the 1930s, you're just countering a massive deflationary private debt bubble collapse. And then as you go into the 2020s, we had basically a pretty slow decade of growth throughout the 2010s. It was somewhat disguised by the massive kind of, a rise of tech companies we've had. So the stock market did pretty well. So individual assets did well. We were obviously a lot more comfortable than we were in the 1930s, where you had worse technology, you had, the Dust Bowl, you had, all sorts of issues. But in many ways, it was essentially a mild depression where you had just growth that was way below the trend line. And then as you go into the 2020s, of course, we had this external catalyst of a virus, and then we saw massive fiscal spending, the likes we haven't seen since the 1940s. And a lot of it was monetized by the central banks around the world, basically having to buy a lot of the bonds associated with that spending. And so like the 1940s, we saw a really big ramp up in broad money supply. And so now the question is whether or not, to what extent that might translate into higher inflation in this decade.
It sure does rhyme.
It's a great analog.
What are the differences in the initial conditions? Are there any significant differences that you would want to highlight between the 40s and where we are today?
Yeah, there are several of them. One is that demographics were stronger back then. So you had a younger population, you had a faster growing population. Now in most developed countries in the world, you have an aged population and a slower growing population. And then two, by then they had actually deleveraged quite a bit of the private debt. And even part of that, it wasn't necessarily from paying a lot of it off. Some of it was paid off, but some of it was inflated away in the early part of that period. But mainly stopped increasing, and therefore started going down as a percentage of GDP. Whereas in this cycle, if you look at private debt and public debt, you did see a pretty clear bubble happen in that 2009 period. And for example, U.S. household debt went down pretty substantially over the next decade as a percentage of GDP, but it didn't go down nearly as much as it did back then. And so now we're in this period where you have, you still essentially have what is a private debt bubble, just less extreme than it was in 2008, 2009 in many ways. And then you have on top of that a much larger, public debt bubble. And so we're entering this period a little bit, trickier because our deflationary forces are larger. And so they basically, it takes more of a higher magnitude of their actions in order to have a inflationary response. And so we're kind of testing the limits of that. Another thing that's different is that, especially for the United States, in the 1940s, we were the largest creditor nation in the world. So after World War I, Europe owed us a lot of money. We had a trade surplus. We were the emerging power. And then, of course, 1940s, we became kind of solidified ourselves as the global reserve currency. But now in this current system, ever since the 1970s, the United States has been running structural trade deficits, structural current account deficits. We have a negative net international position, meaning that unlike back then, foreigners own more of our assets than we own of foreign assets. And so, currently Japan's the largest creditor nation in absolute terms, whereas the United States is the biggest debtor nation in absolute terms. If you look at it as a percentage of GDP, it's a little bit more complex, but the United States is still one of the worst among developed countries, whereas countries like Japan, Germany, and then smaller ones like Singapore, Taiwan, and Switzerland, those are all the largest creditor nations relative to the size of their economy. And so overall, if you get that sort of really big fiscal environment, it tends to be more inflationary for the ones that are the debtor nations, the ones that are running those more structural current account deficits. And so back then, the United States devalued less than many other countries except for Switzerland. Whereas in this environment, in 2020, we saw the dollar go down more than most other developed country peers, although lately we are in a little bit of an upswing. So overall, my base case is that in the 2020s, if we were to get this analog to continue, the dollar could weaken more than some of the other developed country peers.
Can you just talk about that a little bit more and connect the linkages between yield curve control and how that manifested in those bursts of what may be considered transient inflation in the 40s and what the implications are for today? Is that just to help everybody sort of connect the mechanisms together, how the relief valves roll down if countries decide that they're going to, if central banks decide they're going to pursue a yield curve control type of scenario?
Yeah, so mostly and that's one reason I try to separate a long-term debt cycle from a normal business cycle, because normally what we associate with higher inflation is higher bond yields. So if inflation is going to go up, we're going to get higher bond yields like we got in the 1970s, and that's going to have certain implications. But the curveball there is that, in extreme environments, the central banks around the world can override that and say, no, I know that bond yields should be higher to compensate, but we're not going to let that happen. And so that's something I've been writing about for a couple of years now. But at the current time, it's not even hypothetical. We're seeing, Australia has formal yield curve control. It's not as extreme as the Federal Reserve in the 1940s. So the Federal Reserve, that was the most pure form of yield curve control, where they set the maximum yield of the entire duration spectrum. Whereas Australia is just saying, like, we're going to pin the 3-year yield, so they're basically artificially suppressing part of the yield curve. And Japan's, doing that with their 10-year, I believe. And so we see these rumblings of yield curve control, and we see that over the past year, the Federal Reserve in their meeting minutes has cited those, and it basically says that they have that as one of the tools that is available to them, and they're watching some of those other countries to see how it works out for them. Now, if you go back to the 1940s, the Federal Reserve didn't want to do yield curve control. In fact, they hated it because essentially what happens is they more or less gave up their independence for that period of time in the face of an existential crisis. And so they were co-opted into indirectly monetizing government deficits. And then even after the war ended, so the Federal Reserve basically came back to the Treasury and said, okay, we can stop this now, right? And then, Truman's like, well, we need a little bit more. And so there was this kind of ongoing issue. And when you finally got that inflation spike in 1951, that's when they said, okay, we have to split this up. We have to go back to, some degree of independence here, lest we turn into, a banana republic. We have to, kind of regain some degree of market pricing for money. And so that eventually was able to split. But it's very, it's basically one of those things that once you check in, it's really, really hard to check out. And so last time it happened, they were basically locked in place for, about 9 years. And so, if you have a large stimulus, one of the ways that the overall, basically the effect on nominal GDP can be kind of stunted is if rates rise enough and basically make, mortgages unaffordable, and basically, put a brake on economic activity. And that's where you can get that combination where they say, okay, we're going to do massive stimulus and we're going to cap yields. And then, so if you don't cap yields, the release valve is the bond market. So the bond market sells off, yields go up, and the currency stays relatively robust, and eventually economic, nominal performance kind of tapers off. Whereas if you do a yield curve control, there's no free lunch, and so you prevent bonds from falling in nominal terms, but the release valve ends up being the currency, because if bonds are not able to reprice basically to compensate for that inflation, then they start underperforming very, very poorly in real terms, and the currency gets sharply devalued. Then there's other variables to consider. So, for example, if your country is running a persistent current account surplus, you have a lot of underlying currency strength that you have to play with. Whereas if your country is running a persistent current account deficit, and then you suppress yields, you're kind of getting that double whammy of you could have a pretty significant downturn in your currency compared to some of the others that are on the opposite side of that spectrum. And so those are some of the variables I'm watching. At the moment, we're in the part where yields have been on an upswing. Most ways of measuring it, they're still negative in real terms, but they're on the upswing, and so that's helped shore up the dollar. And so the question now to watch is as we go through these base effects, as we potentially go through further rounds of fiscal stimulus, what is the bond market going to do, and what's that going to do to the housing market? What's that going to do to the cost of government financing? What's that going to do to say highly valued tech stocks? And because the economy is so financialized, that potentially forces policymakers to try to suppress yields, and that's where you get into that other leg, that other release valve potentially taking over. And so one of the things I'm monitoring is the pace of that. So right now, I'm not rushing into some of those currency devaluation trades because we are still on the uptrend in terms of yields, and the Fed so far has not been, just like the 1940s, they've been slow to get into it because they've cited directly that basically they sacrifice their independence if they are forced to cap yields.
Well, it's interesting because there's clearly a blueprint to do the yield curve control. And I think I heard a quote that the Fed governor at the time said that the federal government or the federal bank is free of government, but not free from government. That is, they are independent, but if the government wants to do all the things that they want to do, they're not free from ignoring it, and therefore they're going to have to act, right? So that's actually was written in a letter, and it provides a bit of a blueprint for people to say the same thing today. Federal governors of all countries to do it, and so it's certainly not out of the question. But I do want to continue down that path. So I think what's interesting here when we think about global macro for everybody listening here is that we tend to feel like global macro is this long-term prediction of what's going to happen in the next 30 years, but really global macro analysts come in all shapes and sizes, right? People that are trying to analyze the next month, the next 6 months, the next year, the next decade. And I think from your work, Lyn, I think you're very clear as to your overall framework, but also making sure that you're watching the rates of change of all of these parameters before you position your tilts one way or the other. So you just kind of acknowledge that, and you're waiting for a particular change in the dollar and so on. What would the trades be that you're making in order, like either way? So if we see the federal government come in and put yield control, that means it's inflationary. You're an equity-focused individual. What is it what type of trades would you be looking to put in?
So basically, there's a couple major levels. So there's when it comes to the rates question and yield curve control question, some of the big ones we have are bank stocks, gold stocks or gold itself, as well as the value versus growth tilts, or the U.S. versus foreign equity tilts. And so, for example, if you expect an environment where they're going to let yields go up, we're going to have a continued steepening yield curve, then you're in an environment where you want to be into bank stocks, perhaps. I've been kind of somewhat bullish on them for a period of time here. You also generally growth stocks, they've been selling off recently because those yields are rising, and many of those growth stocks were very overvalued. And so I think a lot of people try to make too absolute of a kind of comparison. They say, in this environment, yields went up and growth stocks did fine, and therefore there's no correlation. Well, it's not that simple, because in previous cycles, for example, growth stocks were not necessarily overvalued, and so they were less sensitive to those rising rates. Whereas if you're in an environment where everybody poured into growth stocks because there's so much disinflation, yields got so low, they didn't know what else to invest in, so everybody just piled into all the tech stocks. It caused this huge run up, and then you start to get yields rising. Well, that puts a lot of pressure on those valuations, and so that's what we've seen recently, where you have bank stocks doing well, whereas some of those those hyper growth names have been correcting, and so as long as that trade continues, gold is somewhat in a corrective phase, growth stocks in a corrective phase, whereas value stocks, bank stocks, certain types of emerging markets or foreign equities are doing quite well. I've been bullish on a lot of the base commodities. Copper's been one that I've been riding, for example, recently kind of trimming that a little bit. And so that those are the types of trade I'd like to see from that, that more rising rate environment. Now, if you were to get a move on yield curve control, banks can still do reasonably well in that environment because they still have a positive yield curve. It's not like Japan where they have just a totally flat yield curve. However, when that yield curve stops steepening, that's less ideal for banks, and it suddenly becomes a lot more attractive for something like gold, because gold's closest correlation is real rates. And so if you look at the 10-year Treasury minus, either the CPI or the inflation expectations, the break-even rates, that is a very strong correlation inversely with gold. And so gold does very, very well when real rates are negative. And so if you get that yield curve control environment where, let's say, inflation goes to 4% and the Fed caps yields at 2%, well, now you're at negative 2% real yields, and gold would love that most likely. And so gold stocks or gold, directly held gold can do very well in that environment, as well as some of those other base commodity stocks. And I would actually say that Stanley Druckenmiller gave a great interview the other month where he talked about he's kind of viewing it similarly, where his base case was higher inflation, and then his next question was, will the Fed intervene with rates or not? And so he says if they don't intervene with rates, then his play is short treasuries. And if the Fed does kind of come in and keep those yields from getting too disorderly, well, then he's long commodities because they would benefit from that that more inflationary environment with more negative real yields. And so that's a similar way that I approach as well, with the exception that I've been using long bank stocks for some of my basically the equivalent of a short treasury trade. It's a play on a steepening yield curve, and that kind of like the copper stocks, that might have got a little bit of ahead of itself now, but overall that's the type of thing I want to be in if I expect steepening yield curve, rising rates, pretty strong economic growth.
Are you looking at you listening to the narrative in order to start shifting, or are you looking at technicals with the narrative?
So partially it's the narrative, but mainly it's quantitative data. So basically watching inflation play out, watching the growth of the money supply, watching what's happening in Congress, so watching the stimulus or lack thereof, and then seeing how that's going to play out in markets, and then watching Fed actions to say, okay, are they going to purchase more to try to suppress yields, or are they going to let that run? So you have some central banks like Australia or the ECB that have been more explicit about their desires to keep the long end of the curve suppressed, whereas the Fed has taken somewhat of a more hawkish tone. Of course, it's all relative, so hawkish in the sense that rates are zero and that they're buying assets every month. But compared to some of their international peers, they're saying, we like a steeper yield curve. We're not going to, we're not that, you can read between the lines that they are watching certain levels or watching for certain things to break, but they're kind of, taking a more hawkish stance relative to some of their peers. And that's where you say, okay, at the moment, at least the trend change is higher yield, steeper yield curve, kind of ongoing corrections in growth stocks and gold and things like that. But then, if we do to get that pivot, that's when I'd be more interested in maybe looking at those growth stocks again. And I've already kind of monitoring some technicals as it relates to gold and things like that. And so it's that combination of some of those trend changes as well as technicals.
What do you think is one of the biggest misperceptions right now that's occurring in markets in terms of how investors are behaving?
I would say that, there's a couple of things. One is treating this like a normal business cycle, that basically that you can get out of it in a similar way that the previous cycles played out, because there's such an economic impact, and people went into this with so much leverage, and the bottom 50% in the United States and many countries has basically no dry powder. They have no emergency fund. They can barely go a month without kind of keeping the lights on, without an income, and so basically that if at any point you were to get that more disinflationary outcome in this environment, that's when you're prone to civil unrest and things like that. And so you have that kind of forcing function that keeps the fiscal taps on, in a matter of speaking. And so that's one of the things I'm kind of watching play out. The other thing is just, people are prone to be pro-cyclical and emotional when it comes to things. And so, back during the worst part of the pandemic, people would pile into tech stocks that are doing fine and say, I don't want to touch banks or energy with a 10-foot pole. But they got so extremely cheap that it's like you say, well, I don't know exactly when this is going to turn around, but it's getting to the point where I wouldn't want to not have exposure to some of these things, because when they do, that can be pretty strong. And now at the same time that the reopening narrative can get so excited that basically you're saying tech stocks are done. I want to just pour into energy and banks, and it's like, well, maybe, but you can also go back and look at some of the things that are selling off in the other direction and see if there maybe are certain levels that you want to have on your watch list, and maybe start kind of easing out of some of those reopening trades. And so that's kind of how I'm playing it, where I monitor valuations, I monitor rate of change of economic data, and basically just try to not have a knee-jerk contrarian reaction. Not just, sometimes it's good to ride with the momentum, but be aware when things start to get somewhat heated, and be willing to shift into some of those out of favor names, especially because as an equity investor, you have a pretty long time period for that thesis to play out. And so in some ways, equities are some of the longest duration assets. And so basically they give your trade enough time to play out, where you're saying, I don't know if this is going to turn this month or this quarter, but it's getting into the zone where it's cheap and it's out of favor enough that I think that when these rate of change indicators roll over or roll up, whatever the case may be, that trade can start working out.
I think it's also really important for the listeners to be mindful of Lyn's language. She didn't say sell everything and buy this one thing. She said tilt her portfolio, right? Which is not to say that you're abandoning all of those other sectors out of hand, but you are tilting the portfolio. So you have a base portfolio that's fairly diversified, and then based on whatever your risk parameters are, you will pick an amount that you're going to tilt based on maybe your confidence interval as well as your comfort with tracking error and whatnot.
Exactly. I underweight or overweight certain sectors or certain stocks or certain asset classes based on how attractive they are. With a valuation overlay. So one is just how cheap and expensive they are, but then part of determining how cheap or expensive they are is expecting what's going to happen with future earnings, and so paying attention to that rate of change indicators to see how that's likely to impact them. And so finding things that are oversold and cheap, and that potentially have that catalyst kind of rolling up or rolling over is kind of where this nice sweet spot. My general approach is I ideally like to hold an investment for 3 to 5 years or more, but this has been a really crazy 18-month period, and so there are some things I bought thinking I'll hold on this for 3 years, and then it goes up 150% in 6 months, and it's like, well, now it's so good that it's so good that it's bad now, and you kind of rotate out and kind of clear that a little bit, and so it's been an unusual environment, but that's generally how I like to approach it.
Yeah, way ahead of schedule. What do you do with all that extra time? Right? I mean, you didn't expect to earn 150%, for example, in such a short space of time. So
yeah, well, that's on some investments, and so it's one of those things where the copper stocks, the Bitcoin, certain things like that just kind of flew up, and there's always parts that you don't get completely right. And so, for example, in 2020. Going into that, I had a decent amount of tech stocks, and everyone's talking about you got to get into the work at home stocks. I'm like, well, don't we all know that now? Isn't that trade done? And it's like, no, that people will pile into that longer and higher than you think. And so, for example, by the time we got into summer 2020, I was like, I really should have had more of these things. I have some, but I wish I had even more because I didn't expect, I didn't expect Zoom, for example, to go as high as it did. I didn't expect some of those really kind of hyper growth kind of stocks that really benefited from this trend to go as high as they did. And so, basically you don't catch everything all the time, but overall it's trying to have a portfolio that makes sense to you, that is filled with things that you find that are reasonably valued and that are benefiting from the underlying trend.
So go ahead, Rod.
I'm going to switch topics. So
I was going to. She said the word.
She said the word. So
she said the Bitcoin word. Yeah. So we now will start the podcast.
But I'm going to pretend that it's not just a wholesale change. I'm going to tie it into the previous topic.
Of course we are. We're asset classes allocation.
Laser eyes. We are. Let's tie in inflation to this. So let's assume in a period of accelerated inflation, what you need to look for is scarcity, right? Gold is a scarce asset, has X amount of production a year. It's clearly it's got the network effect. It's broadly distributed. It has the benefit of keeping in pace with real rates. Bitcoin has a lot of those elements, but it has a lot of other elements too. I mean, there's an element of the digital gold aspect, scarcity, and generally broadly distributed, or can become more broadly distributed. And then you have the innovation side of it, which is given it all of its volatility right now. If we go into a period of deflation, which one wins out here in your view? Like, how do you price Bitcoin in your model?
Given those two I think even a slightly broader question, just to open that up a little bit more, is what are the main factors or functions that go into the pricing of Bitcoin in your mind, Lyn? You're obviously put a lot of time and thought into this. So what are those main inputs that you're seeing, and then how do they?
Yeah, it's a really good set of questions. And I view a couple different layers, and it's always tricky to find out which layer is the most important. But by having a kind of a framework that puts layers, that's how I've seen it play out. And so, for example, the biggest correlation that Bitcoin has is mostly just with its own adoption cycle. And so basically, if you look at say put Bitcoin aside for a second, if you look at a really high performing growth stock, it almost doesn't matter if it's in a recession or an expansion, that stock's still growing. It's just doing its own thing. And of course, the valuation might fluctuate to some extent because market sentiment's going over the place. But they're going to be less impacted by a recession or an expansion than, say, a bank stock or an energy stock or an industrial stock, right? So partially Bitcoin is you're monitoring the health of that. What does the adoption look like? What's happening in the industry? Are insurance companies buying into it? What are the hardware wallets doing? What are some of the other applications? How is the Lightning Network developing? And so one is I'm watching the underlying fundamental growth of the ecosystem and the user adoption over time, and how that's being perceived. And so, if you look at the last 12 years of Bitcoin's existence, the tightest correlation is with its own halving cycle. And so for people that aren't familiar, Bitcoin generates, a number of new Bitcoins every 10 minutes on average. And in the beginning, when it was designed, that was 50 new Bitcoins were created on average every 10 minutes. And then after 4 years, that was pre-programmed to get cut in half. And so then it went to a 4-year period where 25 Bitcoins were created every 10 minutes. And then after that, it was pre-programmed and it shifted to 12.5 Bitcoins every 10 minutes. And now we're in that fourth period where it's 6.25 Bitcoins every 10 minutes. And that's set to continue for the foreseeable future until you basically asymptotically approach no more Bitcoin. And generally what happens is that you in the beginning you had a big spike up in price, you got a blow off top, and then eventually the overall ecosystem finds an equilibrium price where it becomes relatively tame by Bitcoin terms, where it's in this big kind of choppy sideways pattern, and that's when you get a supply shock, right? So you get this, the halving cycle comes in and says, okay, well now we're going to cut new supply in half at a time when demand is still relatively persistent, and then eventually you get that drives price up, and that brings in momentum traders, and then that fuels an adoption narrative. That eventually gets to extremes and has a blow off top, and then it crashes, and then it eventually finds another equilibrium, and 4 years later the halving happens again, and there's a supply shock, and then it drives the price up, and momentum traders come in, and we've gone through this cycle about 3 times. And so overall, if you look at the historical chart of the price in log terms and put the halving times on it, it's a really uncanny relationship. It's the closest thing you see to like a clockwork algorithmic pattern, which makes sense because Bitcoin is an algorithm, and its price chart ends up looking rather algorithmic. Now, when you then go to the more micro layer, especially during that period where it's finding a consolidation, so it's not in an extreme bull market phase, then it tends to have more correlations with some of these macro factors. And so, for example, when we had the big liquidity shock in March 2020, Bitcoin went down just as hard or harder than anything else because it's partly a liquidity play. It also just tends to benefit from overall risk-on, risk-off behavior. So it generally is a more risk-on asset, especially when it's in that more consolidation period. And so overall, what I'm watching now is that it's still largely in a post-halving cycle bull market as far as I'm concerned. And so I watch some of the on-chain indicators to see how that plays out. And so, for example, because it's an open source blockchain, even though you can't necessarily see what individual people are doing because there's a layer of extraction between someone and their address, you can still track what's happening with the overall public blockchain to see, okay, what percentage of coins haven't moved in more than a year? What's happening with new coins? Are people selling their coins for a higher price or a lower price than they bought those coins? And so there's a bunch of different indicators you can watch, and you can compare them to previous cycles. And so what you see generally during a bull market is that some of the long-term holders, trim their positions into that because they're up 5x or 10x or more. They sell to the new generation of buyers. And if there are times where you start to get a correction during that bull market, a lot of those long-term holders stop selling. And so that kind of helps solidify the supply. And basically the price has to keep going up if you're going to get those coins out of their hands, because a lot of them, they're not holding their coins on exchanges. They're holding their coins in cold storage. So for them to sell means that, the price has to do something. It could be that they panic and sell, but those are long-term holders. So they tend to be more about looking for higher prices to sell into. And so there's a very large percentage of Bitcoin that is basically just off the market. It's just in cold storage, and you need to pretty much pry it out of their hands with higher prices. So I watch things like, are coins going to or from exchanges on average? Are long-term holders selling, or are they holding? What are some of the extremes? Like if you compare the market capitalization of Bitcoin compared to the realized capitalization of Bitcoin, which is essentially a measure of a cost basis, kind of the average price that all current Bitcoin were purchased at originally, and just kind of compare different indicators like that to see what's happening within the broader context of what's happening with some of the custodians, what's happening with insurance companies, what's happening with, did another company come and say that they're going to put it on their balance sheet or not? How's the development of Lightning and some of the applications that make it easier for people to get access to it and to use some of the other layers that are on top of it. And so that's overall how I approach it. And so, for example, when I initially covered Bitcoin professionally back in late 2017, I passed on it. I analyzed it in November 2017. I said, it's like 7,000. It's gone up really far. And I have certain concerns about some of the things happening in the ecosystem, like the Bitcoin Cash split from Bitcoin. And said, I said, maybe you can play with a couple percent, but I'd be very cautious here. And so I took no position. And of course, you almost tripled from there. So you went up to like 20,000. Then you crashed and you went down to like 3,000. Then it just underperformed for a couple of years and it was choppy. But it was in April 2020 where I said, okay, now it's 7,000 again. But it's in my view significantly de-risked and stronger fundamentally in terms of where it is in the halving cycle, what price action has been recently, and some of the developments in the ecosystem.
So where do we see it right now? You said it was still benefiting from that halving cycle, still a bit of a bull. Are you still seeing hodlers go to the exchanges and selling? Or has that died down a little bit in the last few months?
So it died down a little bit over the past month or so. And so most of the indicators I'm tracking look to be somewhat mid-cycle in terms of the bull market. And so it's less of a kind of a slam dunk in my view than it was back in say, spring of 2020 and summer of 2020, where, you could buy it for 7,000, you could buy it for 9,000, you could buy it for 10, 12,000. So that, in my view, was a kind of a very asymmetric play. Now that you're well over 50,000, in my view, it's somewhat less asymmetric, where your probability of getting 10x gains in the next year is less than it was back then, and your downside is somewhat greater. But I still overall my base case continues to be for higher, unless we see certain signs play out. So if you start making lower lows, that's when it gets concerning. But looking at what's happening with the on-chain indicators, some of the long-term holders have sold into this rally, but still a very small percentage compared to previous rallies. And then particularly over the past month, as Bitcoin has been a little bit more choppy, those long-term holders pretty much stopped selling and just, they just kind of kept holding from there. And so basically they're basically saying that the price isn't high enough for them to continue selling into. And we also saw some indicators that, people are still essentially refusing to sell at a loss. And so if new investors come in at these higher prices and then Bitcoin has a correction, some of them are willing to sell, but once they start selling at a loss, they pretty much stop. And that tends to be what happens during a bull market in Bitcoin terms. The only time that you see mass selling for lower than their cost basis is during those deeper bear markets. And so overall, I think the base case looks healthy. The one thing that's kind of different from previous cycles is that because Bitcoin was earlier in its issuance rate, you had the number of coins on exchanges keep going up. So even during a bull market, you generally had these short periods where coins would leave exchanges, but on average, coins or exchanges kept going up. Whereas in this cycle, we're something like 15 months into a period of coins just keep coming off of exchanges, and that's never really happened before. And so in some ways, that's more bullish than anything I've seen before. But it's hard to say exactly what that means because we don't have a lot of historical context for that.
What do you think about the recent talk around the energy consumption question about how much energy it takes to produce a coin, with the miners?
Yes. So a lot of that is tied to its market capitalization. And so Bitcoin has something called a difficulty adjustment where every 2 weeks it changes the difficulty of the algorithm based on how much hash rate there is on the network. And basically if Bitcoins are being generated more slowly than expected, it decreases the difficulty of the algorithm and vice versa. And so overall at the current time, Bitcoin takes something like it's less than 1% of global energy. And then more importantly, it basically is optimized to kind of seek out some of the cheapest sources of energy. And so, for example, there are places in China where they have overbuilt electric dams, hydroelectric dams. And then during the wet season, they have a ton of excess electricity. Yeah. And so a lot of Bitcoin miners go there and basically are pulling off this electricity that would otherwise be wasted. And so in that sense, it's not competing with other forms of energy. Now, there are many parts in the world, some of other China's provinces, where it is, using more conventional electricity. But basically, the overall incentive structure of how it works is that it's designed to basically, seek out inefficiencies and find these places of stranded energy. Another application I've talked to people in is that you can have, say, flaring, where natural gas is wasted, and some of these miners can come in and say, we can just bring basically a box with miners and put it next to your oil assets, and we can your natural gas assets, and we can just basically use some of that flare gas and give you back a big portion of the cost. And so basically what you're doing is you're making use of the gas that would otherwise be wasted. And so overall, it's something to monitor how much energy it takes. But compared to gold mining, compared to some of these other things, I overall view it as pretty efficient. And it's another one of those things to consider where I view it like it is a piece of software, but essentially I view it like a software product where it takes a lot of work to make, but then the difference between giving it to 1 million people and 1 billion people is a marginal difference per user. And right. So Bitcoin's one of those things where for it to exist is relatively expensive in the grand scheme of things. It's still less than 1% of global energy, but on an absolute scale, it's as much energy as a small country. But then as more and more people use it, that doesn't necessarily scale linearly with user adoption. It eventually becomes a point where it's like sending an email where you're basically taking no marginal usage of a platform that already exists. And so that's kind of how I view that conversation playing out, where there are people on both sides that I think you basically are not quantifying it appropriately. Some people saying there's virtually no energy impact. Other people are kind of saying that every transaction you do blows a hole in the ozone layer. And the overall conversation is a lot more nuanced than that, where it's, for one, it's not really charging for the most part per transaction. It's really about the fact that it exists. And then two, the fact that it scales a certain way where over time it uses a smaller amount of energy relative to its market cap, but it still does use higher energy up to a certain point.
And also, there's other areas that are currently using a ton of energy when we're not measuring. So the traditional fiat system consumes a ton of energy. There's servers everywhere in the world to try to make that work, but nobody's talking about that, right? So if we start digging deeper, I think this ESG, narrative has come from the EU to stop the institutions from adopting it too quickly. Because, like Lyn said, the incentive structure for miners is not to be in a convenient location where they can mine happily. It's to be in the cheapest location and to find sources that are being wasted and to co-locate there in order to be able to maximize or to minimize the cost of their input. And their major cost of input is energy. And so you have miners that are going to look for the cheapest energy sources. And grids, power grids everywhere in the world don't operate at 100% of their capacity. They operate at a very, very low capacity rate, enough for
peak rates
for them to be able to deal with a peak energy requirement, right? And so the vast majority of time, there's excess energy that is being wasted. Like you can't contain that, and you can't store it. And so you're able to have agreements with these companies, these power companies, where you get the excess energy as long as they don't need it. If they need peak energy, then they're cut off, right? So,
well, the nice thing is they can actually feed back to the grid also when peak energy is on, and sell to the grid at certain times, and then take that power and use it to mine Bitcoin.
So it definitely is a narrative that is a bit still developing, and I think, like you said, and both sides have taken extreme positions, and the moderate reality will come out soon enough.
And it's one of those things that goes through cycles. And one of the analogs I compare it to also is Iceland. And so Iceland is a country that has very low electricity costs due to just their geography and their geothermal access. And so one of the things that they did was say, how can we export this electricity? We can't build transmission lines across the ocean, but what we can do is find an industry that is very electricity intensive and use it. And so they basically make aluminum out of the ore because it's a very electricity intensive process. And so countries will ship them aluminum ore, and they'll export that finished aluminum. And so that's essentially what Bitcoin does, where it's one of the few sources of, basically where you go to the source of energy rather than trying to bring the energy to you.
So on the let's broaden the Bitcoin universe a little bit. And what do you think of the other crypto assets like Ether and other parts of the network that you're seeing? What your thoughts are on maybe stable coins or products like Global Strike, and where are you seeing the value chain opportunities for investors? And are things outside of Bitcoin even stores of value at all?
Yeah, so there are a bunch of questions to get into. So one is, within the Bitcoin ecosystem, I know a lot of several of the venture capitalists that basically benefit from investing in some of those companies. And certainly, if you know what you're doing, I think that's a good space to be in, right? So there are lenders, there are I think Strike's doing great work. Where basically, for people that aren't familiar with that, they're using the Lightning Network, which is basically the second layer for Bitcoin. And so, if we take a step back for a second, one of the biggest criticisms of Bitcoin is that it can only handle so many transactions per second on the network. And so they say, okay, compared to Visa, it can handle 1,000 transactions per second. Bitcoin can only handle like 10 transactions per second. And so it's got that fundamental limitation. But it's not really an apples to apples comparison, because Visa is just a layer on another system. And so on the lower system, you have something like Fedwire, which deals with fewer transactions, and on top of that, you have these non-settlement transactions like Visa, where they handle these smaller transactions, and then they batch their payments together on the base layer at a later time. And so Bitcoin is more like that Fedwire system, where it's doing irreversible, potentially bigger transactions. But on top of that, you can build these faster payment networks when you're less concerned with security, because you're buying something small rather than doing a massive settlement, but you're still benefiting from that underlying security of the base layer. And so that's what, for Bitcoin, it's called Lightning, but there are also some other ones. There's Liquid, and so there's a couple of different scaling mechanisms that can basically make it cheaper and faster to do payments. And so one of the applications that is benefiting from that is Strike, which says, okay, now Bitcoin's a really kind of liquid, system. It's large enough, it's ubiquitous enough, and we can do very, very cheap Lightning transactions that are, a fraction of a percent in order to send something. And so one thing they can do is they say, okay, say we want to send money between the United States and Europe, between the dollar and the euro. Instead of, managing all these different currency pairs around the world, we can treat Bitcoin as a common currency pair. And so we can do dollars to Bitcoin, send them over the Lightning Network, and then do Bitcoin to euro, and all these transactions take place in less than a second, so you have very little exposure to Bitcoin's price. And so basically you're using the network more than the asset, and just basically using it as a underlying payment vehicle. And so it can be sufficiently abstracted so that the person using the app doesn't even care about the fact that they're using Bitcoin. They just want to convert dollars to euros and then send euros to Canadian dollars, and then a Canadian wants to send to Australia. And you basically just have this kind of interlocking thing where the underlying common denominator is Bitcoin. And one of their applications is for remittances. And so, for example, if you want to send money to an emerging market, for example, like say you're working in a country but you have family back in your homeland, you want to send them a small amount of money, you can send it over Strike, and your family can accept it as stable coins. They can withdraw it from certain types of ATMs. And overall, I'm very bullish on stablecoin volume in general. That's been a pretty strong uptrend, and I expect that to continue because that has certain advantages over traditional banking systems, and banks are starting to embrace it more. That would go for more of the reputable type. And so, for example, I'm not exactly a fan of something like Tether, but when you look at something like Circle or Gemini, those are putting out more regulated products. Where you're basically, you have a dollar or another currency in some cases wrapped up in this asset that it benefits from the liquidity of being a crypto native asset. And when it comes to some of the other protocols, I mean, Ethereum's interesting because it's the largest utility protocol. It enables a lot of these stable coins and things like that. I have certain concerns about the fact that it's changing its underlying protocol. It's somewhat less decentralized than Bitcoin. In terms of, say, how much control the developers have compared to the nodes, for example. It's overall just kind of a different ecosystem with a different purpose. And one of the ways I view it is that, like most things in life, but especially, money is one of the strongest network effects, where, if you have just thousands of different types of money, really it's going to congregate in the top one or the top two or the top three. And so, the vast majority of those coins out there don't really have sufficient network effect. Really, it's, in terms of storing value, even if you're obviously if you're fine with volatility, it'd be more along the lines of Bitcoin. And if you're going to, do sorts of development and kind of, run your stable coin and run other things like that, it's more about Ethereum. And so overall, my primary preference has been towards Bitcoin as an investment, although I do continue to monitor what's happening with these utility protocols like Ethereum, Cardano, things like that. As well as what's happening in the broader stablecoin space and what that means for banks and how that can impact existing, companies that either have to adapt to it or potentially are at risk from having some of their market share taken.
Do you think that's a real threat yet? The actual banks and banking systems and profitabilities via the Bitcoin revolution?
So not currently. I mean, so for example, there's over $500 trillion in assets worldwide, of which Bitcoin is $1 trillion, and then the rest of the crypto is maybe another $500 billion. And so it's still a very small percentage of global assets. Now, the thing to watch out for is that it's been exponential so far, right? So people talking about $1 trillion Bitcoin that sounds like unbelievable to people like 3 years ago, or even a year ago. And so if Bitcoin basically continues to add zeros, my base case is that it'll slow down over time. But if that gets up to a $5 trillion asset or a $10 trillion asset, that starts to become pretty meaningful, in the global scheme of things. And so overall, I view it, you can also separate store of value from medium of exchange. And so as a store of value, putting a couple $1 trillion in some place doesn't really affect the banking system. But overall, they have started to adapt to some of the stablecoin things that are happening, losing out on some of that payment processing volume they could potentially get, and so especially in terms of low fees for sending international payments and where people want to have their money, that I think has been impactful. And so, for example, you have something like Square, where you can you have this account, you can buy Bitcoin on it, you can now send Bitcoin to another Square account, Cash App account. And so you have that competing with some of the traditional banking systems. And so overall, I do think that's pretty relevant in terms of, especially in terms of attracting younger depositors and establishing banking relationships with younger consumers overall.
Lyn,
fantastic.
What happens when all of the Bitcoin is mined? What's once the mining business is done with Bitcoin, what is the future beyond that?
So at that point, it's mostly fees. And so one is that the last Bitcoin won't be mined for about a century, but it's already at the point where 18.5 million out of the 21 million have been mined. So it becomes asymptotically smaller. And so the short version is that miners, they have two sources of revenue. One is they get the block subsidies, which is the term for the new Bitcoins that are created every 10 minutes. But then they also get fees. And so let's say, for example, a new block comes out every 10 minutes, but it can only hold so many transactions. Let's call it 3,000 transactions. Well, if 4,000 of us want to transact in that 10-minute period, 1,000 of us are out of luck. And so how do the miners choose who they're going to organize into that block? And mostly it comes down to what is the fee that they're willing to pay in order to get towards the front of the line. And so there are some really large Bitcoin transactions. I mean, there are like $500 million Bitcoin transactions where someone pays like $10 in fees to send all that. But let's say I'm trying to send someone $100,000. I'm willing to pay a fee in order to make sure that goes through quickly and securely. Whereas if I was trying to send someone, $300, I might want to say, well, we can wait a little bit until the network's not as congested. I want to keep that fee low because I don't want to pay a $20 fee on a $300 transaction. And so fees are the way that Bitcoin uses to make sure that the more important and generally larger transactions have priority. And so what miners do is they optimize it based on their revenue. They say, okay, who's willing to pay the most fees for the complexity of the transaction? And then they go ahead and implement that. And so over time, you've had the transaction fees become a larger portion of miner revenue, although they still are a pretty small portion of miner revenue. And for Bitcoin to be successful in the long run, and this overall, I had an article on this because I think this is one of the bigger risk factors for Bitcoin. At least it's something that it has to navigate successfully. And if it's going to continue to be successful as it has been, is it has to keep increasing its fee market up to a certain point. And so, basically, as you get into the late 2020s, that's where the block subsidies are pretty small. And by then, you really want to see a pretty persistent fee market. Right now, the fee market is somewhat irregular, and it really kind of comes out during these big bull markets. Whereas during bear markets, the fees tend to be pretty low. But if you get more and more adoption, while that base layer only can do so many transactions, then you can get to a point where there's kind of a permanent fee market. And Bitcoin really has to reach that level if it's going to be successful long term.
That's fascinating.
Amazing.
Well,
it's been quite a bit of time here. We have. Are we close to your closing questions up here?
Yeah, we have one more question, which is would you rather question. Would you rather spend a week in the past or a week in the future? And why?
That's tricky. I mean, I guess if you're talking in terms of financial podcast, if you spend a week in the past, you can go ahead and you can buy Bitcoin at $2. You can invest in Amazon and Apple. You can, do things like that. If you know the future, then you can come back and invest in whatever's going to become the next Apple, Amazon, and Bitcoin. Or you can check. Okay, is Bitcoin going to be like $10 trillion? Is it not? Is it? You can go back and say, is Roku going to be the next? Microsoft is, what's going to happen with some of these big tech stocks. And so really you could make use of either one, obviously, depending on when you want to experience the benefits from that. And then, so I'd have to say the future. I guess I do the future. I've already experienced the past. And so I guess going to the future and coming back to shape some of my decisions about that future is probably the way I'd go. But there's certainly a case for either one.
For sure. It's not the easiest.
Love it.
That's great. Not an easy question.
Yeah.
When you actually start to think about it.
Yeah. It's a little brain teaser.
Yeah.
To finish things off. Well, Lyn, thank you so much. And I will remind everyone who has made it to the end that Lyn Alden investmentstrategy.com is where you can find Lyn's work. And it is, as you can tell from the podcast video interview, however you're interacting with this, her knowledge is both broad and deep, and we encourage you to interact with her service, and also probably write a review on this particular podcast and smash a like button and share it with your friends as well. So I think that would help us all.
Yep. Thanks so much for having me. I really enjoyed the conversation.
Thank you, Lyn.
Certainly a fun one.
Thank you, Lyn.
Yeah.
Us too. Thank you.
Time.
Fascinating. Thank you.